please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's focus on the rupee depreciation. In fact, it's pulled back a little bit, 72.44, but still around a 1% depreciation that you can see on your screen. We have David Beale of Deutsche Bank Asia Pacific joining in on the show to discuss this and more. David, hi. Thank you very much for taking the time out. You join us at a very opportune time here. We have the rupee, which is depreciated 1% today. It's depreciated around 13% year to date as well. What's your view? How are we placed in terms of the rupee, and where do you see levels go from here on?
Well, I think it's really a matter of what we think about the broader EM contagion. And look, at the end of the day, if that is going to continue, then we still see the rupee as vulnerable. But I think we need to put it in perspective. This pales in comparison to what's happened in Turkey and Argentina. And, I think we can lose sight of that. We can also lose sight of the fact that on the sidelines, in terms of the investor interest we see, particularly from the global real money community, that once we do see this EM contagion subside and whatever the trigger for that is going to be, there is a lot of interest, particularly across fixed income, particularly across equity, to come into this market. And I think we do need to be cognizant of the fact that at some point in time, there is going to be as I say, once things settle down and the EM contagion stops, we have a wall of investment interest to come to this market. We're continuing from our Deutsche Mumbai business, we're continuing to onshore offshore investors at a fast rate and really just waiting for the opportune time to come in. So, as I say, I think we need to keep this contagion, the weakness we're currently seeing, in perspective.
David, hi, morning. How much of this is a story of, asking the question, who's next in emerging markets in terms of who gets picked out for some bashing, emerging market forex especially, I mean, the weaker ones, vulnerable ones, current account deficit countries, etc. And how much of this is a story of dollar strength? Money is heading back. I mean, you look at US stocks, treasuries, dollar, US assets are being bid up. I mean, isn't that the big story here?
No, that's a good point, Prashant. And again, the dollar strength has had a big influence here. Look, I think the things we're looking at here and watching closely in terms of where to from here, if you like, in terms of EM Asia FX. First of all, I would talk about the redemption risk, and we're watching that redemption profile closely. Half of the global bond index, EM bond index, depreciation happened in August, and I think that a lot of investors have probably not yet looked at how their asset allocation is going to go. Again, we need to watch that closely. I think the escalations, again, in the China-US trade wars, again, is important. What also tends to happen in times of stress, and we've seen it in 2015 and 2013, is the increase in hedging requirements that come out of the woodwork. They could be corporate hedges in terms of offshore liabilities. It could be all those fund managers who traditionally don't hedge. And I think, again, that's something we have started to see in other countries in the region, and not so much in India, but in other countries. And I think we need to keep a close eye on that. Clearly, the speed at which the Fed moves in terms of whether there is any acceleration in the speed of rate hikes is important. The current gradual hikes that have been priced in shouldn't have too much of an impact. As I say, I think the real impact would come if we saw an acceleration of that. And finally, as we've talked about many times, oil and metals. And I think that much of the drawdown we've seen in EM year to date has been a function of the higher oil price and lower metals. Again, the big question is, what will turn this around? And getting back to the rupees point, that will be the point we see when that happens, we see these inflows come in, which should be substantial.
David, your point is taken that the rupee has to be seen in context of what's happened to other currencies, say this year as well as in the past 5 years. We're resilient, there's no doubt about that. But in terms of the current macro situation that we're facing, our trade deficit has spiked to levels of around 17 billion to 18 billion on a monthly run rate again. In that context, what is the macro risk that you see in India, and what are you advising your investors?
Yeah, so the current account is still a challenge, but I think that, there's a trade-off for that, particularly from a fixed income standpoint. I mean, at these sorts of yields, you know, and you know, a lot of these savings pools around the world, particularly across European investors, you know, are getting paid zero. And at the end of the day, the credibility that has been built up over the structural reforms here over the last 5 years has created a lot of credibility through offshore investors. And so putting aside the difficulties or the challenges from a current account deficit perspective, we still feel that, you know, as I say, the investor interest is there. What is probably more, not concerning, but creating caution, we have state elections at the end of the month, we have general elections next year. Perhaps we need to get through those to see, you know, the real flows come in. But, you know, in the very short term, we can still see, as things, if things do stabilise, that those flows to come in. So, you know, at the end of the day, the macro here, in terms of, as you point out, the imports still rising, you know, the fact that we're not seeing the necessary FDI in terms of flows at present, that can happen and that can come back. So, as I say, we remain more longer term anyway, very constructive on India. We're going through a period of contagion in foreign exchange. If you look at bond markets, they've actually been relatively well behaved. And as I say, once we do see this stabilise, the currency stabilise, that should give confidence to investors to come in.
Okay. Just before we let you go then, David, can you just list out what your pecking order would be within, say, emerging markets, and where exactly does India fit in? I know it's one of your top bets, but in context to or in relation to other countries.
Certainly. Well, at the moment we are seeing probably the one country in the region which is doing better, and we remain quite constructive on, is Thailand. Again, we are seeing, you know, that they have the surpluses, the reserve buffers, and investors are buying, particularly in the fixed income space, into Thailand. So that's one area where we are seeing interest. We're slightly, you know, in terms of being less bearish on countries in the region, is Malaysia. Again, oil's helping there, but again, we're starting to see you know, investor interest come back into Malaysia after the political uncertainties there. Elsewhere in the region at the moment, we are being impacted by this uncertainty. That's obviously been Indonesia and the Philippines, but all of those three countries, in particular Indonesia and India, you know, again, we have that sort of sideline interest to invest, and I think that those two countries remain priorities. China is actually one which, again, has seen more inflows into fixed income, and we remain more constructive there. I mean, clearly a lot has to do with what happens with the China-US trade negotiations. That is one unknown that, you know, may prevent us to see more immediate flows come in. But, you know, clearly China is somewhere where it is a very under-owned bond market. 2% of foreign ownership. We can see that changing a lot over the next few years. So China is one we, again, on a more medium-term basis, we are quite constructive on.
Okay.